Have you heard? Oh, you didn't want to record that other stuff?
I forgot.
No, okay. Got it. Have you heard about what's happening in the state of Washington? So not Washington, D.C., the state of Washington, which is one of the more forward-thinking states. They often do some innovative things, and as it relates to long-term care, and it is creating a frenzy in the industry, and essentially because government knows that, oh my gosh, our population is aging more and more, and our medical advancements are increasing and keeping people alive longer and longer. And one of the things our great wholesaler Michelle Prather often says is, by solving one problem, helping people live longer, we create another problem. And we're finding out by keeping people alive longer, then the incidence of Alzheimer's goes up greater and greater. Lots of times in the old age, our grandparents, they never got Alzheimer's because they died before they could get it. They died of a heart attack and a stroke and fell over with an aortic aneurysm. And these things we've fixed, and all of a sudden now we're living longer, but sometimes very debilitating. And when it comes to Alzheimer's or senile dementia, some very long time things. And there's still many reasons why people need care and need help with their activities of daily living, and they don't have a way to pay for it. And so it falls first on family, and then family can't do it. And so now we need to get professional care. And so I got to pay for this, and I don't have anything way to cover it. That's another thing. I think it's around 10% of the people have long-term care insurance. So they don't have long-term care insurance, so they pay for it through self-insurance. They bleed down their assets to pay for it. And after their assets are gone, after all their income is, their assets are gone to pay for this, then it falls to the state or the federal government. And this is what is Title 19 or Medicaid. And this is expensive, and it's bankrupting I probably spelled that wrong. Bankrupting the government. And so it's a shared cost between the federal government and individual state governments. So the state of Washington said, you know what, here's what we're going to do. We're going to put a payroll tax on everybody to pay for this. And they're adding a tax. And the only way that you get out of this tax is if you can show that you have a long-term care policy in place by November 1st of this year. And so this has created an absolute frenzy of people investigating this. They don't want to pay. They don't want to see their taxes increase. They don't want to pay an extra. I think it's 0.6, and there isn't it's not a graduated tax. If you make $500,000, it's paid on every last bit of this of your income. And it's not a very good coverage either that you're getting through the state of Washington. This hasn't been fully thought out completely, but you can bet other states will follow this. When one state starts something like this, California is already looking at it. Other states will definitely probably get in line because they don't want to go bankrupt as a state. So they're going to say, we're going to tax you because we're going to provide this coverage. And so there's tons and tons of people right now who are in the state of Washington who are investigating getting long-term care policies, maybe not even for the right reason. They're just doing it for tax avoidance. Or in many cases, it's a 45-year-old who says, well, we should, we were thinking about getting that coverage later, but now it forces us to get it sooner. This is great for the industry. In fact, Dave Cacone, because Dave Cacone, he's a broker with us. He's with New York Life. He's one of New York Life's top long-term care. He's an writing agent. He's an expert in this area. Somehow he's into some lead generation through New York Life, and he is his phone is just ringing off the hook. He told me his message is on his phone, yes, I'm get in line, kind of. I'm working on all of these, and that it's just an abundance of stuff. I haven't seen him submit a ton of stuff through us though right now, so I don't know exactly what he's doing. Kathy Seelig is another person who actually she works in that senior space and hooked in with a guy, Mark Glickman, and is looking at this. And there's these like lead programs. You give up a ton of the commission, but you're getting people who are interested in doing this. And so if this is something that you might be interested in, you got to be an expert at long-term care. You got to kind of know, you got to have not just come at you with one type of solution. I can put you in touch with this organization. With Kathy's situation, she's literally only getting 25% of the sale, but it is ready-made. People who are interested in doing this, they're raising their hand, you get on the phone, you do it. I asked her, are these legit? She's not paying anything to get into the program. She's not, there's no downside. And by the way, it made me think of Bill Wilkins. We had that client in Washington. You should just reach out to them and see what they're doing. But if this is something you might be interested in, let me know. I can put you in touch. It might be too late for the state of Washington. It's got to be in place by November 1st. By the time you got it on board, and then whatever, it might be over. But if this might be something to get in touch for future states, or to meet this guy, Mark Glickman, realize 25% of the sale though, that is all you're getting. So just kind of share that. I also share this because we have seen within One America an enormous influx of policies into One America from the state of Washington. And that's messing up the overall underwriting process to a certain degree. What do we call the interview thing? LTCG?
Yep.
What does that stand for?
Long-term care guys.
Cool guys. Long-term care guys. Okay. It's when we do an asset care and you say, okay, now I'm not going to take the medical information. I'm going to sign you up for this. They're going to call you. They're going to ask you your questions. They're going to ask for the doctors. Be prepared for this. Or if you're over a certain age, they're going to do a little cognitive deal. That's how we do it. It's all tele-app. These guys are, and earlier in the year, it got really crazy. And then they staffed up and they said, okay, we're going to do a good job for you, One America. We will meet this standard. Well, they're having trouble with meeting that standard of care of delivery on these interviews again. So if you're running into that, kind of let us know. We want to give feedback to the home office on that. Know that there's a little bit of that going on. They're staffing up again. They're also trying to segment Washington state out from the rest of the country so that we don't penalize the rest of the country by what's going on with all these applicants in Washington. So know that that's going on as well. All right. because of this conversation, there's a lot of talk, and I have a client that, or an individual, not a client really, an individual that I'm working with right now, and brought this up, and you may hear, you may run into this a lot. There are two types of long-term care policies, and I'm going to probably spell this wrong. Indemnity. Versus reimbursement. And when it comes to long-term care, you are essentially paying premium to buy a bag of money, to buy a big bag of money that's worth whatever, I mean, based on your age. And in this case, I think it helps a ton when we use actual examples. I'm going to use a 67-year-old female non-smoker. And you're buying a bag of money that gets streamed out on a monthly basis. And in our case, this is like $5,000. And under the indemnity provisions, that money just comes to me as the person who has this policy, as the claimant. I file a claim. I still have to file a claim. It's still based on, I can't do 2 of 6 ADLs, or I have a cognitive impairment as determined by a certified health provider. In other words, a doctor. A doctor has to say, yep, this person can't do this or this. And that's true both of indemnity policies, and it's true of reimbursement policies. The difference is, and sometimes the appeal is in an indemnity policy, I get this money and I can use it as I wish. It sounds. You get the money and it doesn't have to necessarily go. You can use some of it to buy groceries, and you can use some of it to provide care, and you can use some of it to have somebody come in and get your hair done because you can't make it to the beauty salon now. And so I can choose to use these dollars, this $5,000 a month, how I choose fit. Whereas in the reimbursement, it has to pay to a licensed person or a licensed facility. So I have a long-term care expert or a caregiver who's licensed, an adult daycare person who comes into my house and takes care of me and helps me to bathe and helps me to get dressed and is there 8 hours a day and then leaves. I have to pay. This reimbursement pays to this person, or it pays to an actual facility. And so the reason I didn't have a wholesaler come in and speak about this is because they like to beat up each other's types of policies. So asset care, as we know, is a reimbursement policy. If it's coming out at $5,000 a month and the person's only charging us $3,000 a month, then it's only going to reimburse $3,000 a month. And that will make this bag of money, let's say this bag of money is $360,000, it'll make it last longer. And so I understand the appeal is, I kind of like this because I could pay for a family member, and that is true. you could pay a family member over here to take care of you. So I need the money. I'd like it to come to my family to take care of me. That is actually could be true. And so reimbursement people, Michelle Prather will beat up indemnity policies and say, yeah, but there's a catch. And yeah, but did you know this? And yeah, but did you know this? And indemnity people will beat up reimbursement policies and will say, yeah, reimbursement. Well, what about those extra costs that you have that aren't part of a facility or a licensed person? You're going to need money for those too, right? And what about all that paperwork, that you have to file, and you got to get the bill and you got to pay the bill. And so they say some things that aren't necessarily always fully true. And so my deal is I want coverage in place for the person. If you absolutely like this fact that it's indemnity and you could potentially don't have to have reimbursement and you have this cash flow coming in, great, let's get you coverage in one way or another. Here's what reimbursement people, or the Michelle Prathers, who I love, absolutely the best person wholesaler wise within all of One America, and can help get our policies issued and works with underwriters alongside us, etc. Here's some of the things that she will say are downsides of, I lost my notes, of a indemnity policy. They tend to be more expensive because there's a greater likelihood that I can get, I could find a doctor who says, yep, you can't do 2 activities of daily living and you need care. We all have a doctor in our back pocket, or many people do, and somebody would say, yep, and I can make sure my policy pays out then. And so because of that, claims are greater over here, and because of that, premiums are higher. Okay. That's a knock on them. They tend to be, tends to be more fraud in these cases. And because of that, the insurance companies that write these are much more scrutinous, if that's a word. They put a lot of scrutiny on the claims. And indeed, if you look at the fine print of the policies, you have to re-up every 12 months. You have to prove that you still can't do these 2 ADLs, that you still need coverage. So they're going to investigate continually to make sure, because they're not paying the money to a facility, they're paying it to you. And so I could say, yeah, I can't do this, and I'm actually using it to put an addition on my house. So there does tend to be some fraud. It's not as simple as just saying, okay, I can't do this, and I had a doctor sign off on this. There does need to be a plan of care. So a plan of care has to be submitted of what you're going to do with this money and where it's going to go, and it has to be approved by that home office. So yes, I can have a family member provide the care, but a plan of care does have to be submitted, and that's what needs to be reviewed every 12 months. Also, the money coming out of this could be taxable. So HIPAA says that a certain amount of per diem per day, they adjust this level every year of how much is the allowable amount to be for coverage. Anything above that level, so if I had a policy that was paying out $10,000 a month, then and they said the allowable came out to like 7,000 a month, then I'm going to have tax. Some of it could be taxable. Don't ask me right now what this gets adjusted annually. I don't know what the per diem is, but that would be something to know, and that's always going to change going forward. At the same time, I do like the idea that I have more control over this. I do have more. I can decide where it's going to go. Whereas here, I got to pay to a person, or I got to pay to a facility. And some people, I want to have more control over that. So I get it. Here are some other distinctions with this. Indemnity over here, reimbursement over here. I like to, go as much apples to apples as I could. So the policy I'm looking at over here is a Nationwide, great company. And I don't think these things are bad. Nationwide is a very strong company. This policy type appeals to some people. So if it means I can put coverage in place on somebody and I make their situation better and I get paid, by all means, do that. If they bring it up and want to talk about it and ask about it, I can say, yep. Don't just poo-poo it and lose a sale. Say, is that what you really want? I want you to go into this with your eyes wide open on what this kind of policy does and what this kind of policy does. So let's say our 67-year-old female non-smoker, you can pay for an indemnity policy with a lump sum. And so in this case, she has a $129,000. And interestingly, the benefit is very similar. I can buy with 129,000 lump sum. I can buy a bag of money of $360,000 over here. And in asset care, I'm literally buying a bag of money of $361,998. And this would pay out at $5,000 a month. So how long would that last? For 6 years. This would pay out at $5,430 for 66 months. So what I did was I ran base for 33 months and I did the continuation of care, COB, continuation of benefits for an additional 33 months. And so in both cases, remember, this 66 months or this 6 years is only if I'm taking out $5,000 per month from day one, or only if I'm paying a reimbursing at $5,430 per month, then it's going to run out at 66 months. And this is the maximum one can take out, is 5,000 or 5,400. If I only take out 3,000, it'll last longer until this bucket of money is depleted. And so the two policies, you can't match them up exactly because asset care is at 25 months or 33 months or 50 months, right? And then the continuation of benefit is equal to that or lifetime. That is a huge distinction. Nationwide does not have lifetime. Nobody has lifetime except asset care. So if people love that, boy, that's a great thing. Asset care, nobody has one policy on two people, which asset care has. That is the sweetest spot we are in, is unlimited care and couple coverage. That's why I ran a single person 67-year-old situation to try to get it apples to apples. But what if I don't use it? What if I don't use it? Well, before I go there, let me just say one of the knocks on indemnity is because there is no stopping me from taking the full 5,000, people do. So they draw out the money, and which would, the argument might be, well, then you're going to deplete the 360 faster, whereas over here it's on asset care, it's reimbursement, so maybe it comes out slower and it lasts longer. Okay, maybe, yeah, okay, fair argument. What about death benefit? So if I never use the policy for long-term care, is there a death benefit? Yes, there is. In indemnity, it starts higher and then goes down. No, I said that wrong. No, yeah. Let me look at that. It's so it does increase. So if I never used it, 120,000 of death benefit at age 80, 20 years from 60, or at age 80, it would be 157,000 of death benefit. Comparing that to asset care, if I never use it, 178,000 in death benefit. So quite a bit more, and that's from day one and forever. So death benefit as well as surrender value is stronger under asset care. So 178 in death benefit versus grows to 157. And yes, for those of you who are unfamiliar with these linked benefits, these both are linked benefit types policies. By linked, it means it's built on a life insurance chassis. It covers them for long-term care. If I don't use it for long-term care, it still has a death benefit, which is pretty cool. One of the greatest complaints with long-term care, which we aren't comparing in this kind of thing, is the use it or lose it type of feature. Now that's traditional long-term care, and we sell that as well. And so Mutual of Omaha is a great traditional, I can just buy 6 years of 5,000 coverage. Zero death benefit if I never use it. So one should bring that maybe into the scenario as well. I don't want to confuse the issue. Traditional policies are reimbursement type policies. Mutual of Omaha, where I'm buying 5,000 a month of coverage, a bag of money of 360, zero death benefit if I never use it. But because there's zero death benefit, premium is less. I'm paying as I go. Surrender value. So this was death benefit. Surrender value. Oops, got to bring my pen back. Surrender value at age 80 in this one was 83,000. Surrender value over here with the asset care at age 80, 135,000. So that's what your 129,000 does for you. 129,000 of lump sum gets you very similar long-term care coverage, a little stronger. So to Michelle's point, are they more expensive? Yeah, I'm getting more death benefit and more surrender value over here for the freedom and flexibility that I can use these dollars in the indemnity policy in a non-reimbursement fashion. I could pay my kids or whatever. I'm giving up death benefit. I'm giving up surrender value. Questions? Does it make sense?
Dennis, I have a question for you. These numbers are 67 years old female. How many months of benefits?
So 66 months over here, 6 years over here. And remember, monthly benefit is only if I turn the spigot on, and I'm taking the full maximum out right away. All the way, continuously. That's why I like to talk about the bag of money. They both provide about 360,000 bag of money. And so if I turn on the spigot and I'm not taking it out at 5,000 a month, it would last a lot longer than 6 years. That's always helpful to explain to people, because they fixate on 6 years. Man, well, what if I go longer than 6 years? Well, what if you didn't take out all the money right away up front? It'll last longer. But to do an apples to apples, yes. And under this indemnity policy, the maximum we can go is 7 years. So 7 years times the monthly benefit is the largest bag of money I can get. Whereas Asset Care does have the unlimited. Now, there will be people who tell you, and even people who teach the CLTC course, the guy that we went to, what was his name? Bill Comfort. He's not a big fan of Asset Care. If you get behind, he's more about getting coverage in place, and he just thinks Asset Care is, I don't know, expensive, I guess he would say. He likes traditional coverage. He likes to make them short and fat, which is, I provide is a huge daily benefit or a monthly benefit for a few number of years. Okay. Different people. My deal is where I want to listen to my client and help them sleep at night. Where are you? I want some coverage in place so that you're not bleeding assets to pay for coverage. Good question. Other questions? And I wouldn't necessarily, I mean, I own Asset Care. My hope is that I never use it for long-term care, and therefore I like the greater surrender value, which I can use and loan out and be my own banker with my own thing. I love the death benefit. I can leave, and right now I have a charity as the beneficiary on our death benefit. And so that's why I like Asset Care. I like the fact that I can get unlimited care. That works for me. But I want to ask my client. And the first thing I want to ask my client, following Dave Cacone, when he did the presentation, was, do you have a plan? Let's just go forward. And what would your wishes be? If something happened to you, where would you want care to take place? Would you want to be in the home? Would you want to go here? Who would you want to take care of you? Just get in a dialogue. What would you like it to look like? And how are you going to provide for that? Do you have a written plan? Do your loved ones know your wishes, that you want to stay in your home as long as possible? If the client retires overseas and requires long-term care, does Asset Care cover them if they're out of the country? The short answer is yes. We do provide international care. Both of these policies have international care. It's a frequently asked question. There are some limitations on it. You want to read the fine print. You know, like if it does still need to be an approved facility. Sometimes it'll say it's only 50% of the benefit instead of 100% of the benefit. But the short answer is yes, they provide, both of these policies provide international care. Excellent question. We get that a ton.
For
Yeah.
asset care, they will pay out the base, but the continuation of benefits rider is not eligible internationally. So they must be in the United States to receive the continuation of benefits. So once that base runs out, if they're in a different country, that's it.
Come on back. Good. Other questions? Could I pay for, lump sum I love, but lump sum doesn't always, it's, how are we going to fund this? Well, I don't have an asset that I can repurpose to this. So there are other ways. One of the other great things about One America's asset care, which is very, very unique, is that I can use qualified money. I don't see this. I can use an IRA. I have an IRA that's 100,000, and I move it to an asset care. And what is it immediately worth then? Do you know this answer?
20% more.
Yes, it gets a 20% bump. It's immediately worth 120,000, which then becomes a payment of 12,000 a year for 10 years that goes into the asset care. And that's how that works. I'll tell you a little secret that Michelle told me that we will never hear the home office say until it actually happens. This 20%, they're looking at it right now. They think it's too rich. The economics are not working. And this could come down. So if you have people in this camp, get it done. Take advantage of that 20% bonus sooner than later. Do I have any idea when it's going away? Nope. Before the end of this year, and not going away entirely. They might change the 20 to 15, or they might change it to 10. I don't know. But Michelle said there's a good chance that this is too high in our. So just letting you know that. Good to know. Always good to incent people. Let's make this move now. But I would also say a 10-year payment is an attractive thing that a lot of people use. In this same example with our 67-year-old non-smoker female, if I wanted that same bucket of money, that same pool of money of $360,000 that came out as the fastest it could come out would be $5,000 a month, which if I started after the 90-day elimination period in this indemnity policy, that would last for 6 years. To get as close to an apples to apples comparison, I need to run the 33-month and do a continuation of benefits for 33 months under the asset care. So in that case, I'm paying $15,703. Let's do this over. Where's my eraser? Premium is $15,730. Would buy it for 10 years, so 150,000. 157,000, 10 years times 15, would buy me this bag of money over here. If I use this same exact premium over on the One America side, very close, very similar, purchases a bag of money of 357,000. Death benefit, Over here, if I never use it, of course, if I use a portion of it, then the remaining death benefit comes out at age 157,000 of death benefit. Over here, 178,000. One of the cool things about the indemnity policy is, even, you know, if I use up this bag of money over here, right? If I use it up on long-term care expenses, it's gone, and then I die, there is zero death benefit. Over here, if I use up, over here under the indemnity, if I use up the 360,000, my long-term care benefit is gone, but they always have a minimum death benefit that they will pay out of 24,000. It's an interesting thing. Always will have a guaranteed minimum death benefit, even if I exhaust this. Not true in the asset care. So that's kind of a cool feature. Surrender value, age 80. This one would be worth 83,000. Asset care would be worth 135,000. So there you go. Same 15,000, buys the long-term care coverage, very similar, a little bit stronger in death benefit and cash surrender value. Over here, again, I have my freedoms of how I want to use it. I have an absolute guaranteed minimum over here. Yeah. My thanks to our internal wholesaler, one of them, Jeff Drucker, who did this, ran these illustrations for me. Nationwide is available through our IMO, if you, as well as Mutual of Omaha, as well as many other carriers. If you don't get, you know, One America is our flagship. One America is our strongest contractors and pays us the best, takes us on trips, provides benefits, but don't lose a sale because One America doesn't have the solution for you. So if a person is sold on indemnity and that would make the sale, go get the sale. And we have the place you can go get it. That's the message. All right, we are at 10 o'clock. Any other questions? If not, it was great seeing all of you.
Thanks, Dennis.
Jeff Drucker, you got anything to add?
No, not at this point. Well, I can say that beyond looking at the benefits, look at the contract with One America. It is extremely strong as far as features when you go beyond just dollar amounts.
Yeah, very strong language. Very strong claims paying ability. They're not going to screw you. Hi, Mark Tillman. When are we going to see your aunt? It's time for her to get that long-term care again. All right. Thank you, everyone. Thank you for being here, Janine. Jeanette,
Dennis,
yes?
I have a question for you. Do we have any place that we can see all the recordings, like the list of the recordings, trainings? Is any place that we can go and see them all?
Colleen's computer.
Okay. Fair question. Okay, fair answer. We will contact Colleen. Thank you.
If Colleen, usually you send them out after the meeting
Yeah,
is
she
completed.
sent them in an email, but I was just wondering if there is a place that we can see them all, so you can kind of pick which ones to watch first, or you want to help somebody, then you can go to the list and find them.
We
But
need like a YouTube channel, huh?
we need a YouTube channel to be able to look at them fast. Okay,
Yeah.
thank you,
Well,
Dennis.
Juanita, the only thing
Nice.
I did, Juanita, I created a file and I put them in a file.
Oh,
Any-
that is a good idea, Jeff. Yeah. Okay. Good.
Do you have them,
Good
do you have
idea.
them, do you have them labeled, Jeff?
Well, that's the only thing. You just, what I have is in writing what each idea of the week meeting was about and the date. So from the email date